So some traders now say the only thing that can boost prices is higher demand for fuel. Let's see if our guest agrees. Jonathan Barratt is the Managing Director of Commodity Broking Services and joins us from Sydney. Jonathan, good morning. Thanks for joining us.
Good morning.
Jonathan, what a movement in the price of oil yesterday, down by 8.1% after OPEC cut by almost 2.5 million barrels. Why wasn't the cut supportive?
I think it's quite an interesting thing. I think the market and the traders are really focusing more on the demand side of the equation, demand and inventories. So when they can look at the economic contagion flowing through the market, still concerns in the financial sector, and they look at inventory builds, well, they think that's more of a continuing in the trend, and I think that's why they saw it, why they sold it. I think they just saw it as an opportunity to say, well, I don't think OPEC will adhere to it, so let's sell it. We get the builds, let's sell it, and let's see this demand just fade from the market.
Oil now, as we know, Jonathan, is below $40. We're at 4-year lows. How low can oil go now?
I think that's a million-dollar question. Considering we've seen the volatility throughout this year, it's just been unprecedented. I think when we're generally looking at it, I actually feel that we are trying to find a low. What I would like to see is OPEC adhere to what they're doing in terms of the production cuts. And what we might see is that non-OPEC members will actually adhere to their production cuts. We've seen Russia, they've come out and they're cutting, Azerbaijan, Kazakhstan, all saying exactly the same thing. So I think we might get to an environment where the cuts start to get traction and the stimulus packages in a lot of our economies and emerging economies start to get traction. And when we combine the two of those, then I think we'll see stable oil prices and probably see prices start to gravitate towards the top side.
You cite Russia there, and there seems to be a little bit of market disappointment at Russia's soft stance. Is that the case?
Well, I think it's like Russia's just testing the market at the moment. When they came out with their announcement, remember it was just a couple of weeks ago where there was discussions that they were actually going to join OPEC, and that gave the market a little bit of a rattle, because when you combine the two, they're controlling close to 50% of production. And I think that is a real concern. I think that if Russia really want to make a statement to slow the price fall, then I think they've really got to come to the party and certainly increase that cut to over 1 million barrels a day.
The dollar seems to be out of favour right now, doesn't it, Jonathan? And some say it could be even more out of favour as the days and months progress. What impact's that going to have on the oil price?
I think that's a good point, because, see, when you look at the other commodities, when you look at particularly a lot of the commodities are gold and silver and certainly some of your base metals, we are finding that the weakness in the US dollar is actually giving us some price support. So, but not the case for oil. So when you combine the lot, you can actually find a case and spell out a case that perhaps oil is perhaps the cheaper of all those other commodities. And we see where gold's going, we see where silver's going, and also some of the soft commodities. The weaker US dollar, if it prevails, should support commodities. And if it does support commodities, then why won't it support the oil price?
Jonathan, thanks for joining us. Jonathan Barratt there from Commodity Broking Services. Coming up, Barratt.